Ever heard people talking about stocks, how they invested and got great returns? Or maybe you heard how people get into companies like Amazon or Apple, getting paid passive income through dividends, while the actual value of their shares just keeps climbing. But you don't know what a stock is, how it works, and how to get one. Don't worry, this video explains everything about stock. Stock, also called equity or a share, is simply a piece of ownership in a company. When you buy a share, you are buying a tiny fraction of that business. And to see how this works, imagine your friend wants to open a pizza shop but needs $10,000 for an oven. To raise the money, they split the shop's ownership into 100 equal slices worth $100 each, and you decide to buy 10 slices for $1,000, giving you 10% ownership. If the pizza becomes a massive hit and the business value jumps to $50,000, your 10% slice is suddenly worth $5,000, allowing you to sell them for a massive profit because the company did well. On top of that, when the shop makes extra money at the end of the year, they hand you 10% of that profit in cold, hard cash just for holding on to your slices, which is a steady reward called a dividend. What is a dividend? A dividend is a share of a company's profits paid out directly to its shareholders. When a business makes money, it can choose to do two things with that profit: reinvest it back into the company to grow larger, or give a portion of it directly to the owners as a cash reward. That cash payout is a dividend. But as companies scale up, not all owners are treated equally. When a company issues stock, it generally divides ownership into two distinct classes of shares: common shareholders and preferred shareholders. They have completely different rights regarding how the company is run and who gets paid first when things go wrong. The first major difference is voting power. This is the right to vote on major corporate decisions, such as electing the board of directors or approving a company merger. Common shareholders hold the majority of the voting power, giving you a real say in the company's direction. Preferred shareholders generally have no voting rights, typically one vote per share. They are passive investors who own a piece of the company but have no say in its daily governance or board elections. The second difference is crucial. Who comes first in a crisis? If a company faces a financial crisis, goes bankrupt, and is forced to shut down and liquidate, meaning it sells off all its assets like buildings, equipment, and inventory, there is a strict legal line for who gets paid back first. Shareholders do not come first. Standing at the very front of the line are secured creditors, like banks and lenders who issued loans backed by collateral. Behind them are unsecured creditors and bondholders, such as suppliers and traditional bond investors. Next come the preferred shareholders, who are the first among the owners to get paid. Before any everyday shareholder sees a single dime of the remaining cash, preferred shareholders must be paid back in full, up to their original asset value. In a major bankruptcy, the pool of money is usually dry by the time it reaches common shareholders. At the absolute back of the line are the common shareholders. They get whatever leftovers remain after everyone else is completely satisfied, meaning they often lose their entire investment. So here is your ultimate takeaway. Common shareholders get the power to vote and enjoy unlimited upside if the stock skyrockets, sacrifice their vote in exchange for a guaranteed dividend and a safer spot in line if the ship sinks. But they take the absolute biggest risk in a crisis. Preferred shareholders sacrifice their vote in exchange for a guaranteed dividend and a safer spot in line if the ship sinks.
Where exactly does all this stock trading happen? Stocks are traded on regulated marketplaces called stock exchanges. Think of them as giant, centralized hubs where buyers and sellers meet to trade shares. The biggest names you hear about are the New York Stock Exchange, the NYSE, and the NASDAQ. While trading used to happen on chaotic, physical floors, almost all trading today is handled electronically through massive network servers worldwide. But here's the catch. As an individual, you can't just walk up to a stock exchange or log into their servers directly to buy a share. To get into the market, you need a gateway. And that is where a brokerage comes in. What is a brokerage? A brokerage is a licensed middleman or firm that connects everyday investors to the stock exchanges. When you tap buy on your phone, the brokerage instantly routes your order to the exchange to finalize the trade. Depending on how you want to invest, you can choose between different types of brokerages. First, there are mobile brokerage apps like Robinhood or Webull, which offer simple, zero-commission trading right from your phone. This option is perfect for beginners who want to manage things completely by themselves. Then you have traditional discount brokerages like Fidelity or Charles Schwab, which give you powerful research tools, retirement accounts, and deep customer support. Finally, there are full-service brokerages where human wealth managers give you personalized, hands-on financial advice, though they charge much higher fees for it. No matter which type you choose, the process is the same. You open an account, link your bank, and use your broker to buy your piece of the market. Pick the platform that fits your style, and you're ready to start building your portfolio. You have to choose identity. Are you here to build wealth over time, or are you here to capture quick profits right now? Most participants fall into one of two categories: the long-term investor or the short-term trader. In the next video, we would be breaking down the difference between a trader and an investor and which is best.